Hello everyone. Today we are going to run the risk and rate of return, especially stock. Do you remember the relationship between risk and rate of return in bonds? Yeah, we already learned in chapter interest rate part. As you can see, the value of financial asset can be calculated by the present value of all the future cash flow, and in bond valuation part, this R is calculated by three components: the risk-free rate and default risk premium and maturity risk premium. These two are firm-specific factor, and this one is macroeconomic factor. Because RRF can be calculated by real risk-free rate, it means if there is no inflation, hypothetically, we can call this real risk-free rate, and IP, inflation premium. Right? And we call this R as required rate of return on debt, and it also used as a discount rate when we calculate value of bond, right? So we can write down as this: the value of debt can be calculated by the coupon, and it should be use discount rate. And finally, in the maturity, they get coupon and face value. Right? And this RD can be calculated by risk-free rate, DRP, default risk premium, maturity risk premium. So we can say RD is the function of the risk, right? What kind of risk? Yeah, inflation risk, default risk, and maturity risk, right? So we can suggest a question like this: what kinds of risk factors affect on RS, the discount rate on stock, or required rate of return on stock? So RS, what factor, what risk affect? So in this chapter, we will learn this relationship, the risk and the rate of return of stock. There are two risks. In standalone risk, we also call total risk, and the second one is market risk. We will learn more detail in this chapter. And there are some theory about the risk and rate of return. We called CAPM, Capital Asset Pricing Model, and SML, Security Market Line. So let's run together. Before learning the risk and return relationship in stock, I would like to show you one interesting story, the Mark Twain effect. He is a novelist in US, right? 톰 소여의 모험, right? He suggested one effect. October, this is one of the peculiarly dangerous months to invest in stocks. And he also say, the others are July, January, September, April, November, May, March, June, December, August, and February. He said all the months is dangerous. So it is very sarcastic assertion that speculation stocks is always dangerous. Maybe he lose a lot of money when he invests in stock. So in conclusion, the expected return and the actual return can be different. There are two types of investment risk. The first one is a standalone risk. We also call total risk. And second one is market risk. So we will learn these two more detail in the next slide. So when we talk about the risk, we will start to learn the concept about the probability distribution in Korean 확률 분포. So if you buy your stock, the return is uncertain, right? So the probability distribution means a listing of all possible outcomes and the probability of each occurrence. So x-axis means expected rate of return and y-axis means probability. So we can write down as this probability. So we can see the graph. As you can see, the expected rate of return of the palm X and Y is same. So we can write as this. Expected rate of return of palm X is same with expected rate of return of palm Y. It is 15%, right? And we can suggest a question, which palm is more riskier? Palm X or palm Y? Which palm is more riskier? Yeah, palm Y. Why? As you can see, the left side of the 0, the palm Y is greater than palm X. So the palm Y has more probability to lose the money. Of course, as you can see, palm Y has more chance to get more money. But generally, when we talk about the risk, we check downside risk. So under the basic risk and return relationship, palm Y should be high return, but that is not necessarily that case. Because the high return means high expected return, it does not mean high realized return. When you take a root on variance, you get the standard deviation. Let's jump to this slide. As I mentioned before, there is one fundamental relationship between risk and rate of return. So we can say high risk, it means high expected return, right? Jump to this slide. This slide shows the risk and return relationship. In the first part I mentioned before, there is a fundamental relationship between risk and rate of return. So we can write down as this, the high risk, it means high expected return. Why? If there is a high risk, investors require more return, right? And palm should compensate for the risk, so investor can expect more return than low risk financial assets. This table shows the risk and return relationship. So T-bill has a lowest return, but from this equation, lowest return should have the lowest expected return. But as you can see, the collection agency's stock, it has a more risk, but they expected smaller than this, right? So it breaks high risk and high return relationship. So we can conclude as this: the RS is function of the risk. We can say function of the standard deviation, but it is not good measure. Why the variance is not good measure to risk? From this slide, we already learned the variance measure only one firm's expected return change. So if we assume there is a regulation, investor can buy only one kind of stock, then the variation of the standard deviation can be a proper measure only by one firm's stock. But in reality, you can hold many stocks. It will happen that the stock maybe stock A's price goes down or stock B's goes up. It means all stocks are not moving same direction. So buying many different stocks, we call that market portfolio. and we should find more good measure to estimate the risk. Let's learn with example. Here is the 5 financial assets: the T-bill, high-tech company, collection agency, U.S. rubber company, and market portfolio. This is a market portfolio, and it means all stocks traded in the market. So you can simply understand the KOSPI 200 or S&P 500. Portfolio represents the market. So if the economy is boom, it has a high expected return, and economy is a recession, it has a negative expected return. And T-bill is risk-free rate, right? So even though the economic conditions change, it gives always fixed amount of return, 5.5%, right? And let me introduce these 3 firms. The high-tech company is here, and we can simply understand electronics company. As you can see, high-tech company, the stock return move with the market portfolio. So if the economic conditions boom, it has more expected rate of return. And the opposite case, if economic condition is very bad, they have negative expected rate of return. It moves same with market portfolio, right? Second company is collection agency. The collection agency. They collect what? They collect past due debt. What does it mean? If the investor does not pay back interest or loan to bank, the bank can sell past due debt to the collection agency. Collection agency in Korean to 수금업체. As you can see, collection agency expected return is move opposite with the market, right? So if the market is recession, there is many past due debt, so they can have more benefit from that. But opposite case, if the market condition is very good, there is very little past due debt, so they can expect a negative expected rate of return. Best case is USR. The USR, it means US rubber company. It means tire recycling company. As you can see, it has very strange expected rate of return. In the market recession, their return is higher than market portfolio, and in the boom, it has lower than market portfolio. It can be interpreted as this: if you're a car owner, so in the market is below the average, you just change the tire. But so you can have some benefit the company because they recycling tire and they can earn some money, right? But opposite case, in the market is boom, their return a little bit goes down, right? Why? Because in this case, just buy a new car. So idea here is the income impact. As the price goes up, they replace more expensive items with less costly the alternatives. So in this case, just buy a new car. So they get lower expected rate of return. Case is USR. USR means US rubber company. It means tire, the recycling company. As you can see, their expected return is a little bit strange, because if the economic condition is below average, there is a negative return, and then their expected return goes up in the market recession. Why this happen? Because if the market recession, car owner just replace the tire, right? So there is a many recycling tire, and they get more profit from that, USR. So their expected return goes up when the market recession. The opposite case, if the market is boom, their return goes down a little bit, right? Then above the average market condition. Why this happen? In the market boom, car owner just replace the car, not a tire, just buy a new car. So in this case, USR, US Tire Recycling Company, has very little tire to recycling, so they get little expected rate of return. Then market is above the average. Here is one question regarding this case study. How do the returns of high-tech company and collection agency behave in relation to the market? So what is market represent? Yeah, market portfolio, it represents the market, right? So as you can see, high-tech company, it moves together with the market, right? Market goes down, they have a low expected rate of return, and market goes up, they have more expected rate of return, right? So there is one-to-one relationship. A collection agency, they move opposite direction in the market. So in the market recession, market portfolio expected return is negative, but collection agency, it has positive return, right? Because there is many past due debt, they can have some benefit from this. And when market is boom, market portfolio has a positive return, but collection agency, it has a negative return. Why? Because in this case, there's a little past due debt, they can expect a low rate of return, right? We can summarize that if the market goes up, then high-tech companies' expected rate of return goes up, right? And collection agency expected return goes down. Yeah, in this case, we can apply some statistical term, the covariance, or correlation. It means how much move together. So correlation between high-tech company and market is positive, and collection agency and market is negative. Let's calculating expected return. As you can see, expected return can be calculated by each state of expected return and multiply each probability. So at the high-tech company case, you can multiply these probability, right? These multiply and this. So in the recession, you can multiply probability of 0.1 times by minus 27. So as this. and then you can calculate each state, and then sum of them, that is 12.4%. So expected return of high-tech company is 12.4%. With this process, we can calculate each financial asset's expected return. So this slide shows the summary of expected return of 5 financial assets: high-tech company stock, market portfolio, US leveraged stock, T-bill, this is kind of risk-free bond, right? And collection agency. And what is best investment alternative? As you can see, high-tech company, it has highest expected return. So we can say high-tech company is very good to investment, but what should we consider? Yeah, should consider the risk, right? First risk measure was standard deviation. Do you remember what was standard deviation? As you can see, standard deviation can be calculated by some general formula. This is the expected rate of return and each state expected rate of return. So in this case, we can see how much it varies from the expected rate of return. Let's calculate together. Let's calculate high-tech company's standard deviation. So firstly, we input the when the market is recession. So what is the number? The market recession, the expected return is here, right? Yeah, when the market is bad, high-tech company, they have this amount of expected return. So I can write down as this, minus 0.27, and subtract what? R hat. R hat we already calculated at this slide, right? So input the numbers. 0.124 and power of 2, then multiply pi. In this case, we calculate market recession. So when the market recession, the probability is 0.1, right? So write down 0.1. And repeat the process. When the market is recession, the return is 0.07, and this is the same, right? Power of 2 multiply the probability is 0.2. The expected return is 0.15 minus 0.4. When market is over the average, this is expected return, this is mean return, and market is very good. Yeah, is that and? No, because there is a root, right? So we should multiply power of 1/2, right? Yeah, that is the answer. Repeat this process, you can calculate each financial asset standard deviation. And the next slide shows the standard deviation for each investment. As you can see, T-bill has a lowest risk than other financial asset, right? Because it is risk-free assets, risk-free bond. And high-tech company, it has a highest risk. But that risk is the standard deviation measure the total or standalone risk. So if we assume there is only one financial asset, that is a right measure. So larger standard deviation associates with wider probability distribution of the returns. But in reality, we can buy 2 or more stock, so it is not good measure.